hello again. Right off the bat, why would a pension fund even issue bonds in the first place?
Sure, Paula, thank you for that question right off the bat. We at OMERS, we use leverage prudently to enhance the returns. It's as simple as that. And so we invest across a variety of asset classes, including infrastructure, real estate, private credit. Those lend themselves well to leverage, not only at the asset level, but at the top of the house. And that is our primary reason for using the term notes that I help issue. There are a few other reasons that we do it. There are a little, I would call it secondary. One is the natural hedge. We borrow in foreign currencies. We deploy in those foreign currencies. The other is to help us to deploy into those asset classes. And thirdly, we have a commercial paper program that has short-term floating rate. We will warehouse on that and then look to extend out the term overall.
You run the liquidity pool at HOOPP. So I'd like to hear from you, how do you do your portfolio construction, and how do buying bonds from other Canadian pension funds come into it?
For sure. Thanks, Paula. Appreciate everyone's attention, and thanks to Bloomberg. So yeah, the fixed income liquidity pool is one of the tools that we use within the overall liquidity management at HOOPP. Portfolio construction is effectively the attempt to optimize return within the constraints of risk, as well as you want to optimize, in our case, for the collateral and repo constraints of the securities. So because it's a liquidity portfolio, our focus is on government spread assets, things that have government backing or other high quality instruments in fixed income. So, we do have some modeling that we do, but ultimately it is maximizing return per unit of risk within the constraints that we have as a firm, constraints that we have as a plan. And I think your second question was, how do we use
pension fund bonds?
Debt, yeah. So this is a new asset class for everyone, and I think it's a really exciting one because you have very highly rated entities that are issuing a very limited amount of bonds. It's a structure that we are well aware of as Canadians. It's not foreign to us, and we're comfortable with the credit risk. And I think if you were to say the pension plans in Canada are also among the best in the world, so they have incredible governance, and that also is probably part and parcel of having, for the most part, overfunded or highly funded ratios. So, we're very comfortable with that. We're happy to add it into the portfolio where we see fit. And it also provides us excellent diversification, which is, of course, one of the goals in running a portfolio.
Got it. Brandon, after the very direct first question. So part of your work is the oversight of the funding of OMERS and investor relations as well. So the pension fund not only issues in US dollars, it has issued in Canadian dollars, it has issued in euros, and just last week in Australian dollars.
Correct.
So how do you, what do you factor in when deciding which currency to issue in? And are you expecting to launch new bonds in different currencies?
Right. The way the funding program works at OMERS is it is very deployment dependent. And we expect to continue to be active in infrastructure, real estate, private credit as three primary asset classes that use leverage. And so as our teams are able to go and find opportunities to deploy into Europe, Australia, certainly into the US and into Canada, that is often for us a trigger into let's get ready to issue more bonds. And so it is largely deployment dependent. That currency then generates a need. Our treasury team, which I don't manage, but our treasury team makes a decision on how best to fund it, with whether cash on hand, whether to find that source of funds through other means, or whether to issue the recourse debt. And once we get the signal, we get the machine going, doing the investor relations work and whatever is necessary. So we have a primary need in US dollars every year. Since we started the program in 2019, we've been issuing US dollars at least once a year in the spring of every year. We have done Canadian dollars. We haven't done in the last couple of years, but euros and, as you've said, Australia to support our infrastructure and real estate assets there. Our board has also approved us to issue in the British pound. We have not done yet. To answer your question, do we plan to? Again, it would be dependent on deployment. If there's a sizable need there that we wish to fund through debt, you can expect us to issue in that currency as well.
There is always, markets are always focused on rates. So I wanted to ask you about rates and the impact on pension liabilities. And what do, structurally higher rates mean for asset allocation in your case?
Yeah, so I think there's two answers to that question. The first one is probably a general at the plan level. And, I think what I would say is, the discount rates for most pension plans are 5-6%, and I think when TIPS or real return bonds yield 1.5 to 2%, and the plan discount rates are 3 to 4% real, there's probably, if you're running an LDI plan, there's a natural shift back into fixed income assets because you do not need, in order to be funded, you do not need the same amount of equity risk, and that's just a natural sort of way that things have gone.
So you've been taking risk off the table.
I'm just saying, I think that fixed income is a worthy substitute when real rates have gone from 0 to over 2%, and I think it's only natural that that's a prudent thing for plans to do, generally speaking. And
how do you see rates and inflation going forward, and how does that factor into your work?
Me?
Yeah.
So similar to what Ryan said, at OMERS, we have made a significant deployment into fixed income over the last 2 or 3 years, with interest rates being where they are. I would say between bonds and credit, both public and private, we're almost at about 30%, which is historically different from where OMERS has been. Going forward, I think it wouldn't be a surprise. We're expecting rates to come down. Certainly into 2025, maybe still yet in 2024, but not to the point where it causes us to significantly change any expectation around our target asset mix. We still like fixed income. We're still taking a little bit out of some of the other asset classes to deploy into that. And of course, we're seeing inflation trend down as well. That's very helpful, most importantly, to our liabilities, which are indexed to inflation. All of that should help our funded ratio over time, which is, of course, the core purpose that we're all working towards.
When you're doing investors' relations, how do you present yourself to investors? Being a more credit-worthy.
When we sit across from existing and potential investors, there are usually 6 things we like to point out to them. Some of them are completely familiar with OMERS and with Canadian pensions. Others, they have, what your first question was, why on earth would a pension borrow in the first place? And so we explain all of that. But on the first page of our investor relations deck, what we cover is we are a long-term global investor. We have a captive and diverse contributor base. So at OMERS, we have 1,000 different employers who pay into the plan and 600,000 members. And it is very, very difficult, almost impossible to leave the plan. And they have been with us for 60 years. So that's a second strength. We are independent of the province of Ontario. Our governance operates independently of them. As it relates to our debt issuance program, we are, of course, an SSA issuer across a variety of currencies and tenors to enhance investment returns. We always emphasize that. We limit our leverage to 10% of the plan's net assets, and the leverage that we do issue has priority of claim over the pension liabilities that we're fundamentally responsible for. And those ingredients all add up to a AAA credit rating from certain rating agencies, 1 notch below from certain others. We find that if we express those 6 points, usually so much of the story is well conveyed, and then we're able to go into further detail through the conversation.
How do you reconcile the goals of the overall plan, providing returns for the members and having the liquidity, always having the liquidity necessary for the different parts of the organization?
Yeah, for sure. Well, HOOPP has a very sophisticated collateral management program. We're active in repo and collateral markets, and this is just one of the tools that we use. When you are working in liquidity management, your goal is to make sure that the whole plan can do what it needs to do and optimize, not just, I guess you could say, there are other asset classes that will take priority over yourself oftentimes, and so you want to make sure that there's enough liquidity around so that everyone can invest when they need to and how they need to. And so, we're just very sophisticated in managing repo and other things so that we can allow for that.
And what are your plans? Like, how do you divide what you invest in Canadian companies versus Canadian fixed income and overseas fixed income?
Sure. Well, we're a primarily Canadian dollar plan, but like many plans, we have assets all over the world. So the majority of my portfolio is in Canadian dollars, but not exclusively. You know, the intricacies of our market have seen a couple things happening. You could say that in the case of the provinces, we've had slightly larger programs, generally speaking, and they've done a good job of pre-funding. I think there's some worries about the U.S. election, and so I think the last week I saw provinces are 83% funded, but we're about 53% of the way through the fiscal year. So if anything, that's created maybe a little bit of softer spread environment for that relative to, but they haven't widened. It's just that everything else has rallied in, and Canadian spreads have sort of stayed in the same place. So, you know, to the extent that we want to find value, we find exceptional value in Canadian assets, generally speaking, relative to U.S. assets. That could change, but right now, coming back to Canadian dollar product is actually a really easy trade for us. You know, you get diversification, you've got some really strong issues, and you have sort of prudent amounts of leverage. So
that makes sense. Brandon, why do you invest? Why would you use term debt? Like, in which specific situation?
So term debt being, having the fixed rate, knowing that it's longer duration is a natural fit against some of our assets that are similar in nature. So typically when we're investing in real estate and infrastructure, these are 5-10-year assets, if not longer, et cetera. And so again, there's that natural, I'm going to use the word natural hedge again, to have fixed rate, fixed term debt against those assets. Those assets, assuming they've reached a level of maturity, are paying generally a stable cash flow, higher than the interest rate that we're paying on the debt. The term matches naturally as well. And so it's just an elegant way of adding leverage to the portfolio to enhance those investment returns.
Okay. So I'm going to ask something that applies to both of you in different ways. So Ryan, in portfolio management, and for you, it might apply to your funding strategy. So if liquidity is an alpha factor, meaning if you're liquid when the markets are at extremes, then you can take advantage of opportunities that others can. How do pensions value asset liquidity when their liabilities are illiquid, meaning like different from mutual funds that have to mark daily? So exactly, how do you value asset liquidity?
So what I do is probably the least value add relative to the other parts of the plan, right? So liquidity is first and foremost for the team that I work for and for myself. You know, how do we do this? We tend to stay and are going to far more liquid, lower returning things. You know, as the economic cycle kind of goes towards the 8th or 9th inning, depending on where you think it is, you know, you want to safeguard liquidity so that when there is a dislocation in markets, the other asset classes have the opportunity to make outsized returns. So I kind of have to act in a counter-cyclical way to provide liquidity for the rest of the plan to take advantage of those opportunities that we may see in the future. And you could make the argument as well that as asset returns are very strong, the spreads in my market are very low. So there's not that much pickup for me to take incrementally more risk. So it's a very easy trade for me to kind of go up in quality and sort of protect the fund for the future in case we do get a dislocation in equity markets. Other asset classes within the fund will be able to take advantage of that.
What about you, Brandon?
So at OMERS, we like the concept of the triangle where you've got a trade-off between three factors. You can earn returns, you need to have liquidity, and you can manage risk, et cetera. And moving too far across any one of those sides would move you farther away from the others. And so for us, yes, we need to achieve what is now characterized as the 5% real return over the long term. We must do that to satisfy our liabilities and increase the reserves for the pension plan. That's why we exist. We must also make sure we're providing liquidity for market downturns, to satisfy all the liabilities that could come due at that time, but also to your point, we want to make sure we are able to take advantage. Third, of course, we want to manage the risks that are inherent in both of those, earning too low a return or not having enough liquidity, et cetera. So it is really about that trade-off, that judgment. There's all sorts of scenarios that we're doing through risk and through treasury, et cetera, to make sure. Where my team plays in is we are a strong source of liquidity in those downturns. And specifically, a AAA borrower in those downturns is more likely, not guaranteed, but more likely to have access to the funds that it will need to be able to take advantage of those market opportunities. And so when we keep going with our investor relations and we manage our leverage ratios and we have an active program out there, we're adding to that liquidity buffer overall.
Makes sense. What keeps you up at night as an investor?
Yeah, I think it's inflation. I think the U.S. economy is doing probably a little bit better than the media would have you believe, and we haven't been through a cycle where inflation is 2 to 4%, wherever it might land, and I think what does that look like for assets? What does that look like for the economy, and how do we sort of manage around that? That's probably one thing. And that's probably also for the plan, generally speaking.
What about you, Brandon?
As a debt issuer, what keeps me up at night? I think to characterize it as keeping me up at night is maybe a bit extreme, but where we're really motivated is to get the OMERS name and the Canada Pensions names more and more understood across the globe. And what that will do is that will help us, if we need to access the market during a little bit more of a trying time, that will help us just generally grow the presence and hopefully tighten the curve a little bit more, et cetera, as we go on. So it doesn't quite keep me up at night, but certainly keeps us motivated in what we're trying to do from a funding perspective.
You have not yet issued in an Asian currency, and I imagine OMERS, and I know OMERS is growing a lot in Asia. Is that part of your plan? Like, are you making an extra effort to be known in Asia?
We are making an extra effort to be known in Asia, but not because we anticipate issuing in Asian currencies. Today, OMERS doesn't have all that much allocated proportionately to an Asian currency, apart from Australia, of course, which we've talked about before. But of course, Asian investors like to buy US dollars and a host of the other currencies that we do, including, again, Australian dollars. And so, yes, marketing there, yes, getting our name known there, but not likely to issue in those currencies.
I know you're seeing a lot of value in US Treasuries from a liquidity risk point of view. Is there anything else that you think, like any corners of the fixed income market that you're seeing outsized values that you'd like to share with everyone here, the small audience?
I think Canadian mortgage pools are a very good value. And for whatever reason, I think the buyer base has probably stepped back a little bit, and so there are pockets of value in that. That's an area that we're focused on.
So I'd like to thank both of you and everyone for listening.